Hey everybody, this is Ryan Mallory doing stock market crash update number 14 for you. The Nasdaq 100, it's literally 3% away from establishing new all-time highs. That's right, that means if the stock market rallies next week, we could actually see new all-time highs printed on the Nasdaq 100. The S&P 500, it's 13% off of the all-time highs. The Russell, it's doing a little worse. It's 21% off of all-time highs. Why is that? That's because the FANG stocks are not in the Russell. They're predominant in the Nasdaq 100, and they're about 20% of the S&P 500. That means Facebook, Amazon, Apple, Netflix, Microsoft, Google, they represent more than 20% of the S&P 500, closer to 25% actually. That means their sway over the Nasdaq, over the S&P 500 is monumental, but they have no presence at all in the Russell 2000. That means that if the Russell goes up because of those stocks, it's just going up in sympathy because the rest of the stocks in the market are pulling it up because they're also going up because of the FANG stocks plus Microsoft. So the purpose of this video is to give you two different cases. The case for the bulls, the case for the bears. Which one's going to win out in the end? I'm going to give you my clear technical analysis for each case going forward, why you should be bullish on one hand, why you should be bearish on the other hand. Let's go ahead and get into it right now. Now check out this daily chart of the S&P 500. Yes, the S&P 500 has rallied massively off of the lows. It's like 35%, 36% off of the lows. However, since April 9th, it really hasn't done much. It's trading sideways. Now people will say this market's overbought, but is it? Because we've been consolidating for the better part of a month now, and you could say that consolidation is a pause in the price action before it breaks out and goes up to new all-time highs. If you look at the volume has come down incredibly. Retail investors, they're back into the stock market. They are buying stocks. They're using their stimulus check. For those making less than $75,000 a year, the stock market was the third most popular choice of what to use their stimulus check money on. That's right. That means the government, not only are they doing quantitative easing, they're actually using the stimulus checks to get people to buy into the stock market to boost it higher. It's a government-funded stock rally. And guess what? We get another round of stimulus checks. Guess what people are going to do with that money? Especially if they made money off of it the first time. They're going to put it back into the stock market, keep it going up higher and higher and higher. This is a retail rally. The institutions aren't part of this rally. The retail traders are, and they're pushing the stock market up. So guess what happens if you do another stimulus check? Maybe this next one's going to be even bigger and better than before. Maybe we'll start getting monthly payments. If that's the case, stock market goes right back up. You get unemployment benefits, put it in the stock market. But the volume has come down because the institutions are not buying into this rally. The retail traders are. You're not seeing a lot of panic in the stock market right now. When we do see sell-offs, there's not a lot of volume associated with it. And if you don't have the volume, you're not going to have the sell-off. Until the volume comes back, you don't have sell-offs. But look at this chart here. Going back to March 23rd, volume has been declining each and every day practically. There's less and less panic in the market as a result. There's not a fear. There's only people buying the dip at this point. And as the market goes higher, you're going to have more and more people jumping in out of the fear of missing out. If you look at the SPY, there's a lot of gaps, particularly this past Monday. What are these gaps coming from? You're getting a lot of pumping on headlines off of vaccine news. There's only two things that the market cares about right now. That's the vaccines and states reopening. They don't care about earnings. They don't care about GDP. It's priced into the stocks. Apparently, the stock market keeps going up. You could say that earnings are going down 100% next quarter. Market probably wouldn't give a rip. It'd probably rally even higher because it only cares about the vaccines. You get Moderna or somebody else or Gilead putting out positive news on a vaccine, market's going to be up 100 points. You get another state that's reopening, market's going to be rallying off of that. That is what the focus is on right now. There's also a huge rotation of capital going out of some of your more traditional sectors into the technology sector, into the healthcare. That's why you're seeing stocks like Facebook, Amazon, Apple, Google, Netflix, Microsoft. They're all trading at or near all-time highs. Perfect example is the technology. This represents all your technology stocks. It is almost at new all-time highs. Very well could see that this coming week. But now take a look at energy. Yes, it's had an atrocious couple months and it's rallied pretty well in the last few weeks. But guess what? It is way off of its recent highs still. Take a look at financials. Always been a very popular traditional sector. It has not rallied like the rest of the market has. Not rallying like what technology's doing. Industrials, same thing. Yes, it's bounced off the lows like almost every sector has done. However, it's not really showing the growth at this point that some of your other sectors are, like healthcare, like technology. Because when you pull up the healthcare sector, look at what we're seeing. Almost a retest of its all-time highs. Take a look at utilities. This is what used to be the safer sector in the past. Utilities is actually declining over the past month. So what does all this mean going forward? It means that the market's trying to create a new economy, create a new market where the traditional sectors are not the ones that are going to lead the way higher. It's going to be tech, it's going to be healthcare, and those are the ones that are going to be pushing price higher going forward. That's where your biggest companies are at now. And we haven't even mentioned the Fed yet. They've got unlimited quantitative easing that they're undergoing right now. They're buying up all the bad loans. They're insuring every kind of investment grade bond or corporate grade bond. They're doing everything they can to keep a bid in the market, and they've already even said, hey, we're even rolling out buying stocks in the future. They've got a constant bid underneath this market that's going to keep the market propped up. Now that's my bullish argument. There's not a lot of technicals on it because why? The technicals have exasperated themselves. The argument for the bulls going forward is the same that it was for the last 2 months. That's what they're hoping, that the status quo does not change, that states continue to reopen, that the coronavirus does not continue to spread, that people do not continue to die. It's based off of the hope that GDP rebounds, that people get their jobs back. And of course, you got that constant bid underneath with the Fed. That's why everybody keeps saying, don't fight the Fed, don't fight the Fed. Right now, you have the retail traders thinking that they are the contrarians in the stock market, that they bought the lows and that they're riding this back up, that this is the way to be. Nobody else is doing that. Well, I hate to break it to you, but everybody's buying the dip right now that's a retail trader. You're not alone. You're in the crowd. You're in a huge crowded place right now if you're buying stocks. How about the case for the bears? Let's jump into that right now. You have the S&P 500. We can draw a Fibonacci retracement level from the all-time highs to the recent lows. And what do we get? We have price hovering right around the 61.8% retracement level. Slightly higher. The grand scheme of things, it doesn't really matter unless it can break itself off of it, kind of like what the Nasdaq 100 has done already. But if the S&P 500 can't do that, we see another week lower next week where the index starts to fill this huge gap from Monday of this past week. Then 61.8% is still in play. You also have this consolidation pattern here, right? We talked about it as a bull case that it could be a reason for why stocks are calming down for a little bit, trading sideways before the next push. The bears can actually say the same thing too. These distribution channels can break either way. It can break to the upside, it can break to the downside. In the case for the bears, or why it would break to the downside, is because smart money's getting out, dumb money's getting in. Your dumb money sold at the lows, thinking that the market was going to fall apart. Market bounces back up. Now that dumb money's trying to get back into the market, fearing of missing out of the big rally back to all-time highs. They said, wow, I've already missed all this money that I could have made back if I would have just stayed in the stock market. Now they're getting back in at this consolidation level. Market tanks again. They're the ones that are going to be left holding the bag while everyone else gets out. Also, pulling up the 50-week moving average on the weekly chart, the S&P 500, we have not broken through that yet. That is a key level for the S&P 500 going forward. It has to break through the 50-day moving average. If it doesn't, we are not out of this mess yet. You go back to 2008, it's insanely crazy how similar the charts were. January, February, March, we sold off each month. What did we do? April and May, we rallied. And then towards the end of May, it sold off. You can see it right here. That's your 2008. And what did we do? We touched the 50-week moving average and then sold off massively after that. Yes, it was a great rally for the S&P 500 at the time. I remember trading through it. I remember people saying, okay, the worst is behind us. We're going right back up. Wrong. The S&P 500 ended up selling off 7 of the next 8 weeks in a row. And that was only the start of it. Guys, we have GDP numbers. We have unemployment numbers far worse than anything we saw in 2008. And yes, the market can have momentary periods of where it's priced it in for now, and they start to rebound like what we've seen over the last 2 months, until the rug gets pulled out from underneath you again and we start selling off and breaking previous lows. This is the monthly chart of 2008. See here? We had a 5-month sell-off, and then in April and May, it ended up rallying, touching the 20-month moving average, and then just seeing the entire bottom of the market completely fall apart. Fast forward to today, what do you have? The same thing. You had a 3-month sell-off in January, February, and March, sold off, and then we rallied 2 straight months. So what does this all mean? It means the month of June is going to be an incredibly important month for the stock market, both for the bulls and for the bears in determining future direction. If the market rallies in the month of June and continues to push price higher, if we see the Nasdaq take out all-time highs, yes, there's a good chance that the S&P is going to follow suit and do the same exact thing, and that the bear market's over. But even if we see just a little bit of selling, or we see a 1 or 2% pullback, it could be the start to a much bigger pullback that takes us into the end of the year. The rally has been fueled by retail traders solely. The institutions are not buying into this. Does that leave you scared? It should be, because guess what? The institutions are the ones that usually get it right. The retailers are usually the bag holders. The institutions want nothing to do with it, but the retailers have never seen this big of a presence in the market ever before. They are buying stocks with such fervor that it continues to push the price higher because of the absence of the institutions. But when you get this herd mentality, and when the market seems to be too forgiving, too easy, that's usually when you're the most vulnerable. That's when the market becomes the most dangerous, because that's usually when the rug pull happens. We talked about gaps earlier. There are a lot of gaps on the chart for the S&P 500. Looking at SPY, you can see we have a big one this week, not filled yet. But we also have these gaps from April 6th, March 31st, and March 24th, when this whole market rally started in the first place. So I've laid out the case for the bulls and the bears here, okay? Whatever side of the camp you're on, I gave you something to tickle your fancy. I will say this, I'm still on the bear camp, where I don't think that this dead cat bounce is going to last forever. Now, here's the thing. That doesn't mean that I don't trade to the long side, okay? In the trading block, I've got long positions. I've got them in gold. I have it in LRCX. I have it in MasterCard. Okay, but I also have short positions too. There's Caterpillar, there's BMO. It's okay to still have long positions, but still be bearish on the overall market, believing that the market is eventually going to retest the March lows and likely break them. And we talked about the FANG stocks having this huge influence on the stock market of late. What is going to happen if you see a correction in those? It's going to have way more of an influence than what we've ever seen in the stock market before with those 5 stocks. This is record high influence for the top 5 stocks to have this much of an influence on the overall S&P 500. That means if they start to pull back, let's say there's a 5 to 10% correction, let's say there's some really bad news that comes out about them. What is that going to do? It's going to have a huge impact, particularly on the Nasdaq 100 and also on the S&P 500. The Russell won't get hit as bad, but traditionally, the Russell will fall apart when the other indices fall apart. We like to talk about V bounces, but we don't like to talk about the dead cat bounces that happen in between. When the market does eventually find a bottom, yes, there will be a V-shaped bounce. Unless unemployment drags on for a long time and earnings growth stalls out, then we could maybe see a L-shaped bounce or a U-shaped bounce. But right now with the low volume, there's not a lot of buying power that's actually pushing this market up. So if the sellers come in, there's not going to be a lot of buyers there to step in and buy the stocks, which means you're going to have a dramatic pullback. And if you see the sell-off both in energy, small caps, and the FANG stocks, which doesn't happen much of late, it's going to see those 100 and 150 point sell-offs in the S&P 500 come back very quickly. Feel free to like and subscribe down below. That's going to be the end of this video, but I appreciate you guys watching each and every week. I'm trying to do 2 videos every week, and I appreciate your loyalty to this channel, and I look forward to growing with you as traders and as investors going forward as we navigate one of the most difficult markets of all time. Thank you, take care, and God bless.